Good morning,
Hello.
Size Traders. How's it going? Amos here with Gary, head trader at SizeTrade. As you probably all know, the markets have been range bound for quite some time now with low trading volatility. So, Gary, we wanted to ask you, what's your take on this? What's going on right now? Why are we in such a tight range? And when do you think we're going to break out of this? Gary, you with us?
Hey, size traders. Yeah, I'm right here. Just wanted to touch base with you guys while the markets are slow here and kind of break down what's going on in the markets because the markets are acting a little bit unusual. They're really range bound. We've been, I believe, in a 10-day consolidation range where the market is closed in the 2260 level every single day. There's been false breakouts and false breakdowns. So I just wanted to touch base with what I think is going on, what I think is going to happen long term, and when I think this low vol situation is going to resolve itself. So firstly, let's talk about the reasons why we're in this low vol area. We just had a major election upset with Donald Trump, and the markets had to readjust itself for that resolve. So basically, what ended up happening is when the market realized that Donald Trump would have the House and the Senate, it put together and said, what are the Republican agenda and what is Donald Trump's agenda to do? His first agenda was infrastructure. He spoke about that on the day he won the election. And that's seen as positive for the overall US economy and GDP because people are talking up to a $1 trillion stimulus over the next 2 years with shovel ready projects that are going to come into the infrastructure. So that was immediately priced in on actually the day of the election when the results were given. The market was down around 1,000 points overnight and then reversed when he gave a speech talking about infrastructure and actually went positive the next morning. Secondly, we looked into tax reform. Right now, the markets are pricing in a high probability that he's going to do a quick tax reform for corporations, at least, lowering corporate tax rates to make them more competitive with the rest of the world, a 5% or 10% drop in corporate tax rates or effective corporate tax rates should increase bottom line earnings by 5% this year, 5% next year, and so on. So once we start pricing in these new scenarios, we start seeing that earnings per share actually should rise. The problem with this scenario is that nothing has been written down yet. Nothing has been enacted onto law, and nobody knows how long it's going to take. So currently, the earnings per share are trading at a level consistent with the fact that we don't have new corporate tax rates, that there is no infrastructure package. So the market based on that is looking very expensive because it's using a model that analysts don't know how to properly predict in the future. So they're not raising estimates for the year, but they're saying that estimates are most likely conservative and low. So if you look at it on a historical PE ratio, the market is trading at a very high multiple and is higher than the historically would make sense or would be called fair value. Now, on the other hand, the market has priced in a high probability that all this stuff is going to get done, and not only get done, but get done quickly. So the market ran up after the election, I believe it's 11 or 12%, and basically is stalled here because the market is pricing in a high probability, I would say around an 80% chance of getting tax reform through, getting an infrastructure bill through. But unfortunately, it can't continue to go higher, that extra 20% until that's enacted into law. On the other hand, it's not going to go higher either because corporate earnings are still low since it's not incorporating the potential of a corporate tax rate. So what's happening is the market is too expensive to continue to go higher without actual any anything being done by Congress and the president. But on the other hand, it won't go down because there's still a high probability of these corporate tax reforms and infrastructure project being built in. So nobody wants to short the market because if that's announced, then you're going to see the market pop a little bit higher. And nobody wants to necessarily get long the market because it's really expensive and there's a high probability priced in already that these things will get done. So basically, the 2 weeks leading up to the inauguration, the market began to stall and stay in this 2260 level, where you have basically a fight between the bulls and the bears. The bears are saying everything is priced in, it's going to take longer than you expect. The Democrats do have the filibuster, which is under 60, the Republicans have under 60 votes in the Senate. So unless they can pass some parts of the budget through that Democrats are on board, then they might block it or filibuster it. On the other hand, if you cut taxes and you raise spending, the fiscally responsible Republicans who ran on the Tea Party concept are going to have an issue getting that through. So now we're getting to the point where people are actually taking a look and really trying to come down to when will these laws be enacted, when are these bills going to get passed. And I think that the bears are betting that either they're going to take longer than expected or are not going to be as powerful or potent as the bulls are pricing in. And that there's also a negative side of Donald Trump that markets are kind of not looking at, which is all of this protectionism and free trade battles that he's about to enact. So the question is for the bulls.
So Gary, if I can just interrupt you for a second, how do you think that's going to be priced in the market? All the trade deals which he wants to sign, or trade
So
deals
I
which he wants to get rid of.
Yeah, I think the market is overlooking that personally. I don't know when the market is going to take a look at it. I think he's made it pretty clear on his agenda that renegotiating some of the free trade deals, particularly NAFTA, the North American Free Trade Agreement with Mexico and Canada, is going to be one of his top uh, first things that he wants to do. The question is how does it play out? What kind of tariffs does he put on? How does that affect corporate earnings? We've heard a lot about companies wanting to leave, stop developing plants in Mexico, going to create jobs here. But you're talking about it's great for headlines and it's great for mainstream, but on a more bigger macro level, 1,000 jobs here and 1,000 jobs here is not going to affect overall employment and overall wages in the United States. My personal opinion is that a renegotiating of some of the free trade agreements will be good long term for America. It will bring back jobs to America. It will hurt corporate earnings. So in the near term, you're probably going to see some corporate earnings being affected. But in the long term, it's going to push wages higher. It's going to create innovation as wages go up. One of the reasons why robotics has been innovating at a slower pace than we've seen in the past with new technologies is because there's no need for it. As jobs go to China and Mexico and wages there are around $2 to $3 per hour, robotics, big spending innovation into robotics doesn't make sense because it's too cheap for labor. If you start bringing those jobs back to the US when the unemployment rate is at 4.7%, even though minimum wage won't go up and it'll stay around, I don't know, $10 an hour, whatever it is, the lack of labor will push up the price of wages. So as wages start going to 12 to 13 to 14 to $15 versus what they're being paid for in Mexico and Canada, I apologize, Mexico and China at $2, $3 an hour, you're going to see companies now start investing much more money into the innovation of robotics to figure out how to decrease the wage aspect. Now that the average wage goes from $3 to $15, it makes sense for companies to do that. Now, on the company side, on the corporate side, yes, earnings will get affected, but wages for the majority of U.S. companies don't make a huge portion of their margins. And what will happen is if you do get a corporate tax rate cut, it'll probably offset or be a little beneficial to corporate earnings. So basically what's happening is because all of these unknowns are in the air, you don't know how to price future earnings. The markets trade 6 months out.
So Gary,
Yeah,
so the major competing factor here is corporate tax cuts versus what's going to happen with these trade deals.
I think so. I think at the end of the day, the market cares about earnings, right? Uh, and growth rate. So if the earnings picture could stay stable, then we're probably overpriced. If the earnings picture could increase because we have GDP growth because of the infrastructure project, which will create more spending, which will trickle down to the corporations, which should trickle down to salaries because you need to hire more people because now you have more demand for your product. So that should create a better GDP growth rate, which has a very good correlation with earnings growth rate. So the question is if you take everything stable and we grow at 2%, which is roughly what we've been doing for the last couple of years, and you don't get any hiccups and you don't get a recession, then what will end up happening is you're probably going to be around $120, give or take, for the S&P 500 earnings by the end of the year. So that's your base case. So now the question is now traders and money managers are starting to price in different aspects. So the aspect is if we could get an infrastructure package passed through quickly and it's a big one, then maybe second half of the year we're going to see an increase in the overall GDP rate from 2% to closer to 3%, which should increase earnings per share growth rate, and you get from 120 to maybe closer to 130, $130 per share on the S&P 500. Now, to offset that, or let's talk about the positive first. Then you have the potential of a corporate tax rate cut, which would right away help bottom line earnings, as if they're playing an effect around 30% and you get it down to an effective rate of about 20%, and that increases your gross margins by 10% without really doing much. So if you could increase 10% right away, you go from 120 to 132 on the earnings, because there's no real cost when you get that type of benefit. Then there's also the speak of potentially repatriating money from overseas. We have, I believe, $1 trillion of U.S. corporate earnings overseas that haven't been paid taxes on. So if you could bring that in at a lower tax rate, or convince the companies to bring it into an infrastructure bill where they have to tie up the money for 5 years, but give it to the government at a very low interest rate, maybe even 0% interest rate. Basically, all of these things need to be priced into earnings. Now, the negatives are that you have a potential free trade agreement that's going to be cut. You have a potential trade war with China, and a lot of the U.S. corporations, because of how U.S. policy have been for the last 15 to 20 years, have pushed globalization and have moved a lot of employees and wages overseas. So now they're going to have to be able to bring that back effectively, efficiently, and quickly if Trump does act on it and make it hard for these companies to use workers overseas. And how does that negatively affect earnings per share? So you kind of have to put it all into a formula and come up with a number. I believe that at 120 to 130, the market is probably overpriced here. Between 130 and 140 is probably fair value, and I think that's where people are probably taking a look at it. They're looking at 130 to 140 earnings, and then you have people who are very optimistic who are looking between 140 to $150 of earnings. So that's basically what's going on right now. And you have this big fight, and usually these fights happen all the time on a lower level when you have basically how much is growth rate going to go this year. We're taking a look at interest rates typically to see how that's going to affect markets, lending, and so on. And you usually say, okay, well, we'll grow 1.5 or 2.5 or 3.5, and you could base off of earnings per share based off of that. And some people could be a bit more optimistic, some people could be a bit more pessimistic, and that's how the market moves. You have the bears who say the market is overvalued because people are not pricing in certain negative effects into the market that are going to hurt earnings per share. And then you have the optimistic people who say, hey, everything is great. We're underestimating. Companies typically do better. We have buybacks. We have this. We have that. This is all possibly going to affect earnings, and earnings are going to be higher. And then basically the market decides who believes in what numbers more, puts a fair estimate on it based on the growth estimate, and says, okay, this is what we believe fair estimate is on the market, and the market typically trades around there until we get more news. And it's easier to predict, so the market doesn't have these hiccups like it is right now. Right now, the biggest hiccup is that we don't know how long any of these speculated moves are going to take, and if they're going to be able to be passed.
So inauguration was just this past Friday, and what you're saying is we're kind of in like just a holding pattern at this point.
I think we're coming to the end of that holding pattern, because I think we're going to see how quickly he's able to move, how well the Senate and the Congress are going to have his back. So we're kind of waiting and seeing. I think every day that passes by that we don't get any type of sign of an infrastructure project or some type of reform on taxes, I think that's a negative for the markets. And I think that I think the markets were expecting it to happen pretty quickly. There were even rumors that it would happen on Inauguration Day on Friday. I think that's why the market swooned when he spoke. I think they were hoping that he was going to talk a little bit about infrastructure and taxes. I think when he didn't speak about that in his inauguration speech, the market took a dive. It crashed around, it went down around 0.5%, and then later on rebounded. But I think that every day that passes by, that he doesn't talk about infrastructure, that he doesn't talk about corporate rate taxes, that the Senate doesn't move on that, I think that's going to be make the bulls who are pricing it an 80% chance or a 70 to 80% chance of this stuff getting done relatively quickly. I think what you're going to start seeing is they're going to get cautious, and they have a lot of profits, and they're going to start taking it. On the other hand, if he does start talking about it and he mentions it and it seems to be part of his agenda, and we see that he has the backing of the Republicans at least, and the Democrats are okay with some portions of it, and we feel like he could actually get it through, I think that the market is going to start pricing that other 20, 30% that's off the table because, like I said, the market is pricing a 70 to 80% chance that this stuff gets done. So I think people are reticent to get short too much here because they know that there's at least one leg higher if he starts talking about this stuff and they could get really hurt. And I think the bulls are reticent to buy more because they wouldn't mind the pullback because I think no matter what, they're optimistic about the future with Donald Trump, some of his policies. But I think they also understand that if stuff doesn't get done quickly, that the market is probably a little bit overpriced. So they're not necessarily buying right now. But if the longer it takes them to do, I think some of the weaker longs are going to start getting nervous and they're going to start selling, especially if the market drops a little bit here. And you have some of the longs who got involved at 2250, 2260 level here for that last leg up, that little breakout. If the market drops to 2240, 2230, you might see acceleration from those guys who want to get out and say, hey, I bought it to catch that last little blip to 2300 on the S&P or 2400 on the S&P. It's not happening. Going to take a small loss and get out. I think some of the long-term guys, I don't think if they'll sell, but I think they might wait for a better buying opportunity. I think they know that the market is a bit expensive here. I think they know that. I think in their opinion, earnings per share probably going to go up no matter what. The question is to what degree. Like I said, is it 120 to 130? Is it 130 to 140? Is it 140 to 150? So obviously you got the people who don't care what happens and are going to say the market's going to go up because earnings are going to be 150 or 145 no matter what. And you have the bearish people who say, we're going into a recession, the US dollar is strong, this is bad for US manufacturing, the free trade agreements are really what Trump is going to really look into, and that's going to be negative for corporate earnings, at least in the short term. Wages are going to go up. That's going to force the Federal Reserve to raise interest rates faster at a faster trajectory than the markets are pricing in. So you have those both sort of sides. We call them perma bulls and perma bears, who are always bearish or always bullish. But 80% of that market, I feel like the majority of those people think that earnings per share are going to go up this year. Are they right or wrong? Who knows? But that's the feeling, and the market is always right until it's not. So basically, you could be right and say, hey, we're going into recession at the end of the year, but the market still could go much higher before that the rest of the street catches up to that. So I feel like the majority of the people on the street right now think earnings per share should go up. Question is, to what degree will they go up and so on. So I think on any pullback, you're probably going to get some type of floor where these buyers are going to come in. Now, that could all change if we get some rhetoric from Trump, if we get some rhetoric from the Congress and Senate, which shows that maybe this tax reform will be a little harder to get. Maybe it's not going to be as positive as we first expected. The filibuster is still there. It's going to be interesting to see how many Democrats cross the aisle with Donald Trump. Donald Trump is seen as a villain in the left liberal side of the country. So even if some Democrats might agree that we need a spending bill and that it's okay to lower corporate taxes to get that spending bill, I'm not quite sure if they'll agree to vote with Trump, kind of like what the Tea Party did with Obama, where their idea was no matter if we like it or not, just disagree, vote against it. And again, the Republicans have this a nuclear option, which Mitch McConnell, the head of the Senate, could do, which is basically it's called conjuncture, I believe, which allows the Republicans to pass stuff with 51 votes. The problem is by using the nuclear option and killing the filibuster, you can't put it back later. So if later on in 8 years or 4 years or whatever, you have a Democratic president, a Democratic Senate, a Democratic House, that gives the opposition, in this case the Democrats, but in that case it would be the Republicans, the inability to stop anything. One of the reasons why the Republicans were so successful at stopping a lot of Obama's legislation was because they had the filibuster and they were willing to use it. The Democrats decided not to use conjunction, not to use the nuclear option, what they call, and basically Harry Reid, who was the head of the majority leader, decided that it was better to try to get some Republicans over the aisle, which at the end of the day never happened because the Republicans hated Obama so much. And now you have the quite the opposite with Trump being a villain, and we're gonna have to see. We're gonna have to see how this all plays out. Um, my personal feel is that when we do resolve, we're gonna resolve to the downside right now. I'm not saying that a bear market is coming. I'm not saying that a massive crash is coming. I'm just saying that I feel like the market's got a little bit ahead of itself. The P ratio is very high right now on a historical basis, and they're pricing in a lot of positives and not looking at a lot of any of the negatives at this point.
Gary, thank you so much for your time. For all SizeTrader subscribers, we'll keep you updated. Until next time, this is Amos with Gary, head trader at SizeTrade.com. Thanks.